Hi everyone. Today we are going to discuss this amazing trading strategy from a trader in the Algo trading community in Reddit, which has got more than 800% returns from 15K to 100K in live trading since December 2024 and more than 400% return in the backtests throughout the whole year. We're going to discuss this amazing strategy, and although this trader does not reveal the strategy itself, the post generated a huge amount of attention, more than 300 comments, and in the comments he describes sort of parts of his strategy. What I am going to do is to summarize the parts of the strategy that he has described based on these comments, and then I'm going to talk about parts of the strategy that we understand. I'm also going to talk about how he backtested the strategy and what we can learn about backtesting some strategies. And then I'm going to talk about some tips on how you can make a similar strategy yourself. So let's get down to the details of it. Post says, he found a statistical arbitrage with a 1% return per day. Of course, you are free to disbelieve him and say that, he's just making up stuff. And again, he's not revealing his strategy, as it would result in the alpha to vanish quickly, as he says. But based on, a lot of the comments that he makes, the detail that he explains the strategy in and how he's able to answer these questions, I think most of the people in this community find it quite plausible that he did find this strategy. Of course, it doesn't come without its own drawbacks, and we will discuss those as well. So again, what I did, so maybe we can first start by going through the post itself. So as he says, he is using some simple rule-based approaches using only market data, and he only buys stocks. He does not dabble in futures, options. He does not sell. He doesn't short sell. He only buys long. And then we'll talk about his entry and exits in greater detail. And then he answers a wide range of questions, which we will go through. So that's the idea here. Okay, let's start with what I did is to sort of take these 300 comments and especially his answers and boil them down to sort of a summary of what his trading strategy is. So let's first start with his core philosophy. So the first thing that he tells us is that he believes that these handcrafted rules, he has some logic based on handcrafted rules, and these logics are of the form of like x greater than some threshold, which he talks about here. So those are sort of and the rules are like, x is greater than the threshold and x2 is greater than some other threshold or less than some other threshold. He believes that these handcrafted rules work for him. He said he tried a lot with machine learning algorithms and black box models, but it does not work for him. So from what we understand about his strategy based on what he has told us, the main reason why his strategy works, his intuition around it, is the fact that it profits from retail trading behaviors. So post 2020, in a lot of these small stocks, meme stocks, but not just meme stocks, in a lot of these smaller stocks, there is sort of more a high ratio of retail to institution. And what he is saying is that by looking at this sort of behavior, he's found that there are some daily price pattern in these volatile stocks. So he finds these volatile stocks and he has discovered that there is some price pattern during the day in these volatile stocks, and that is what he's trying to exploit. He's trying to exploit the fact that there is some pattern that these retail traders, because there is not much institutional interest, there is maybe some momentum that these retail traders provide during the day to these volatile stocks, and he tries to use that to his advantage. So that's his core sort of idea of his trading, and he sort of went through and visualized a bunch of such stocks and formed the hypothesis. So we'll see what his entry and exits are now. So this is his execution logic of his trade. So he looks at about 5,000 stocks, mostly the US S&P 500 and other, NASDAQ, NYSE. That's kind of what he looks at. He said in the comments, and he basically has a screener which picks 4 to 10 stocks which are highly volatile. He doesn't tell us what this screener exactly does. He said it has 4 main filters. Based on his comments, we can guess what the 2 of those are. He says he's aiming for highly liquid stocks. So if the stock, so ADV stands for average daily volume. So the average daily volume is below a threshold, he doesn't touch the stock. Why? Because he doesn't want to get into some pump and dump trap. So he's looking for some liquidity. He's also looking for not exactly penny stocks. He's trying to trade small stocks, but not exactly penny stocks, because he feels that he wants to reduce the fees. He's trying to take care of the fees so that the fees don't sort of eat into his profit. So those are the 2 signals that he tells us. He has 2 other key thresholds which have likely to do something about momentum. I'm guessing something around, a huge gap up probably. And so he looks at the daily data and then picks these 4 to 10 stocks. So that's his screener. And then once he picks that, his rules are terribly simple, extremely simple. What is his rule? His rules are that he has a fixed time to entry and a fixed time to exit across all trades. No dynamic entry exits, no stop loss, no take profit, nothing. So he enters at a particular time, exits at a particular time. He doesn't tell us what those times are, but that's what he does. So for example, if we were looking at this candlestick chart here, let's say his theory is that he should enter at 7:45. So he would sort of buy a stock at the open here, and then maybe his theory, I'm just making it up, is that he should exit at sometime around 10 or something. So that's his theory. And so he would just exit his position somewhere here. So that would be, and then that would be sort of his profit. So that's his theory. He doesn't care about stop loss. He doesn't care about anything else, but that's his theory. Few other points about his execution. He holds positions for a fixed time window. He doesn't care about the market events, and these are short term and they are intra-day trades. He never holds positions overnight. So those are his rules, and that is what he does. How does he do risk management? Terribly, not very good, I would say. He uses his entire capital every day. So every day he's using his entire capital, but his hope is that he's spreading them across these 10 stocks, which means that he won't lose all of his capital in one day. Although I kind of disagree with it, but whatever. And he also keeps his trades under 0.1% of the daily volume, because he is a small stocks and he doesn't want to influence the price movement by his own actions. So those are his entry and exit rules. That's how he executes the trade. That's kind of what we understand. There are a few things that are still unanswered, but largely we understand his strategy. Of course, this is the things that we don't understand is these key signals and these entry and exit times, right? Okay. So again, all of this being so now we've understood his strategy. Let's look at what the problem with his strategy is. So the problem with his strategy is he has no stop losses. He can have a very bad day, and he's lost 70% drawdown in one trade, and he says that he takes about 2 weeks to recover from some of his losses. So that is really, really risky. So he talks in detail about this. A lot of people ask him about his, strategy, like the drawdown, how he's handling it, and he says, I'm never using margin. I'm just trading stocks. I'm not trading, and I'm trading only with money that I can lose, and that is my risk management strategy. And I am willing to accept this 70% drawdown, and that is sort of, there are no free lunches. You have this strategy with 800% win rate, like returns, but you have to accept that huge drawdown. That's sort of, I think, the big risk of this strategy that you should know. Performance, as we discussed, I mean, he discusses a bunch of things about the performance. His returns are 800%, and I want to show you his backtest results. I think yeah. So he talks about his backtest results here. So let's see. So every year, so he doesn't have a losing year. 2020, it does really well, but it does pretty well throughout. It does exceptionally well after COVID. That's kind of what is going on here. And he talks about the maximum drawdown, 60 days rolling, and so on. And then, yeah, that's his. So that's pretty good. And so basically, what he did when he tried, and let's talk about backtesting. So what he did is he's backtesting his data from 2003, and he's relying on the backtest to tell him that even if he has a 70% drawdown, he will eventually be on the positive side. So I made a few notes about how he backtested, and that's sort of because we are sort of backtesting is what we do. That's our bread and butter in this channel. It's good to understand what he's doing. So he says he's using Python. No, nothing like pandas, numpy, no cool libraries, nothing. The most important thing is that, yeah, so he is, so he has a low polygon subscription tier, and basically what he is doing is that he's trying to take the data for the daily data. He's trying to take the daily data here. Maybe I should mention he's trying to take the daily data for these 5,000 stocks, and he also takes the delisted one so that he doesn't have survivor bias. He takes this and stores all this, and then he runs the screener. So remember that he had this screener where he screens from 5,000 to 4 to 10 correlated stocks. So for every day since 2003, he finds these 4 to 10, and once he finds these 4 to 10, he only loads the intraday data for these 4 to 10 stocks, and that's kind of what he does. So his backtesting is not too complicated. We understand what he's kind of doing with the backtests. Now let's talk a little bit about the yeah, so he also, the cool thing that he mentioned is that he tried a lot of machine learning, and he mentioned that he's sort of in this space. He's sort of a Python developer / data scientist, so he knows what he's doing on machine learning. But machine learning, it wasn't very useful. He tried to do XGBoost and so on, wasn't very useful. It failed to improve his performance. But what did work for him is this kind of a rule. Clearly, he has like 3 or 4 rules, but whatever. So he said something interesting about feature engineering that we should think about a little bit. And I sort of bookmarked the part where he said this. This is really important. So he says, I think a lot of this comes down to the fact that the data is highly nonlinear and extremely noisy. So he has some parameter y, which is, let's say, some indicator, and he's trying, feature x, and the gain of the trade is y, and the main feature which he sort of thresholds on, this is some indicator that he has, and this is what it looks like when he sort of plots the trade gain against this feature. There's nothing to see, and this is kind of what we see against many of our indicators if we sort of try it. But he says that when he sort of takes this mean of the gain, above some threshold and plots the scatter plot, then he can see this very, very clear view. And that's, I think, a really, really interesting point that he makes that we can learn from. And our goal here is to learn from his strategy and devise similar strategies. So he says that, this change of variable which he found by playing around, that is the main key to his success, and it would be very hard for an ML model to do that unless someone can sort of hand engineer this kind of feature. And that's the key to his success, is being able to hand engineer these features. So that's pretty much what I wanted to cover. Let me see if I wanted to cover anything else. So we covered backtesting, the trade execution, the risks. So maybe one thing to want to cover is that he talks about this IB async. If we are trying to use, if many of you are trying to use any kind of automation library, he uses this IB async library to place his trades in an automated way. So that's good to know from him. But other than that, I think we should sort of come to the key takeaways of this video of his approach. I think the most important thing to take away is that the simple hand engineered features, that's what is successful for him. Machine learning isn't as successful, and the main reason he says is because of the feature engineering, which needs to be done manually. He relies purely on backtesting. He can have a 70% drawdown, but he doesn't care. He relies on the fact that he has backtested from 2003 and he's good. And he's going to keep on taking trades even if he keeps on losing. And then at some point he says that even maybe in this whole thing is that in the text itself, he says that his biggest enemy is himself. The worst enemy is himself. He's lost 10K simply trying to revenge trade by deviating from his strategy. But just fixed rule and discipline, that's the best thing. You cannot beat that. Don't revenge trade. Don't try to sort of manually trade. And so he says that he believes that these simple strategies don't overfit, and that's the reason that he uses these simple manual rules, which I kind of agree with him. It's easy to overfit with a complicated strategy, and then when you actually use it, and it doesn't work in the future. But those are the key takeaways of this video, and I hope you enjoyed the video. We learned a little bit about his strategy. If you want to mimic his strategy, we learned part of his strategy. We learned 2 of the 4 rules that he has. And you just need to invent the rest of it and the time period. And we also learned a lot about how to construct a strategy. And I feel like that is the main takeaway. You might have a different strategy, but you learned how to construct a strategy based on this very large amount of comments, which I parsed for you from this strategy. Thank you. And please let me know in the comments if there is anything else you want me to cover about this strategy, and please like and subscribe if you like this video. Thank you.